Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today, post Fed meeting, post CPI release. Got some PPI wholesale inflation numbers this morning. NBA Finals Game 3 was yesterday. I'm coming up on a Father's Day kickoff vacation. So we got all kinds of cool stuff to talk about today. As it's beautiful outside, sitting here in home studios, I can see how nice it is. So all that is to come, but we still have a show here to do yet today. So a lot to talk about. I can't wait to get started, man. What's on your mind here this morning?
Well, you said it was game 3 last night, but it felt like game 4. I mean, that door is shut. As an NBA aficionado,
Yeah,
so sad to hear Jerry West pass away. Uh,
yeah,
Amazing life. One of the top 5 point guards in NBA history, but in my opinion, the best GM in NBA history. Left his mark on the game. He's responsible for the Warriors that we know today and love.
sure. Sure.
Also, Steph Curry's game. But yeah, man, no team has ever come down from 3-0, and I have no clue how the Mavs are going to do it, despite the fact that style of basketball wise, they're my favorite team. And also, I would like to say happy early Father's Day.
Yeah, thanks, man. Appreciate that. Happy early Father's Day to all the fathers out there.
Yeah, my dad
Hope
as
you
well.
guys
He might
have
be
a
listening.
yeah.
Tom.
That's right. Shout out Tom. Looking forward to seeing them on vacation as well here. Our family, as you know, Eds, goes out to same spot in Michigan. Have been there. This will be our 10th year now. So very excited about that.
Wow,
And it looks really good.
I
But
can't wait.
before we get into that, before we get into all the fun, we have to actually do this show here today. So you can already tell where my mind's at. It is a little bit more at ease based on the data that we got yesterday, but I have a few bones to pick with the press conference. Powell's pre-recorded or pre-written, notes were fine. People started asking questions, and that's where things started to get off topic and off track. But I'm here to put us back on track and give some perspective. So for those that might be watching the show for the first time, welcome. Please like, subscribe to the show. That way, every time we do this, you get notified right on your phone or email. You can always find us at shepherdwm.com right at the top of the website. It'll take you right to our YouTube page or Spotify. It also gives you a whole bunch of information about myself, background, about the firm, and everything that we're here to do and how we serve our customers. And before we get into all the CPI, the PPI, the Powell comments that I have a bone to pick with, but for those watching the show for the first time, usually we provide a huge historical lens to everything we talk about. And the reason for that is, the reason why we do the show, quite frankly, is for our customers, because we know that in this digital age, everybody has a smartphone. They get the news pushed to them on a very consistent, regular, daily, maybe hourly or by the minute. All the information that's going out there um, across the economy. And usually, if you're a news entity of any way or any kind, your job is to get eyeballs on your content, whether it's TV, article, what have you. That's how they generate revenue. So that's their business model. Now, what news entities understand is the nature of the human being, their audience. Their audience, made up of humans, is just like the market. The market is made up of human beings. And the news is going to say, hey, here's the information you need to be concerned about. Here's something to be aware of, if you will. And there's nothing wrong with that. Again, not knocking the business model for any news entity, but what the news does a terrible job of, in our view, the majority of the time, is they do not provide any historical context saying, hey, viewer, yes, this is something that you should be concerned about. Here's maybe some reasons why. But more importantly, here's how the reaction was by the market, i.e., other human beings, under the exact same circumstances. Matter of fact, here's an example over the last 100 years of 17 times we've been through whatever that headline risk news was. And by the way, here's how human beings responded across the 11 sectors of the S&P over the next 6, 9, 12 months under these circumstances. Now, the reason why that's important is for two reasons. One, if you understand what human beings have done in the past, that's one way to control your emotions under that, quote, stressful headline news that your phone or your email is pushing in front of your eyeballs on a daily basis. That's how we control our temperament here. And Warren Buffett said that's the number one reason why individual investors don't sustain the type of returns that they are hoping to have on a consistent basis, because they allow their emotions to dictate their financial decisions, which in general is a very bad way to go about making a investment decision. So that's the first thing. And the second thing is we're putting probabilities in our favor now. Now that we understand what other human beings have done under similar circumstances, well, I don't know about the audience listening to this podcast here today, Ez, but human beings haven't changed all that much in the last couple thousand years.
No, they
So
have
they're
not.
actually, we're pretty predictable. Therefore, the market over a long period of time is pretty darn predictable. It averages 10% over any lengthy period of time that you want to look at. That doesn't mean it's going to average that today or this month or even this calendar year. Over the course of the last 100 years, that's exactly what the S&P 500 or the stock market has averaged. So over long periods of time, we are very predictable because the market's made up of humans. This is why we spend so much time on the historical lens of things. It's been a huge game changer for our customers from a performance standpoint. And quite frankly, we have a lot of satisfied folks on the service side because we push out this information that the news otherwise doesn't give you the full picture for. So everybody's happy, their emotions, their blood pressure is low. And of course, the performance has certainly helped their experience here. Now, don't get me wrong, past performance of all that historical information that we're talking about is not a guarantee of future results, but you are putting probabilities in your favor. And I want the probabilities in my favor. I don't know about you.
Oh,
That's,
totally. And we can go ahead and take a small victory lap here. Your probabilities have been excellent over the past few years.
I do appreciate that. But today's show is not going to touch on hardly anything from a historical perspective.
Oh,
We're going to get to some viewer questions. I'm going to cover the data that we actually know, from the last, I don't know, 28, 30 hours, something like that. But this is more going to be my reaction, all right, to some of this information.
okay,
Less
got it.
history today, taking a step off my history soapbox for one podcast.
What?
And then we're going to take a 2-week break because, like I said, I'm going to go on vacation. And
I
then in
might,
July,
I might find you. I might find you.
I'm sure you will. But we'll definitely do this again, maybe post July 4th, and I'll get back on my historical soapbox here for everybody. And I'm looking forward to it.
Yeah,
But today's
Joshua,
more of
I
a
already
reaction.
don't know who you are. This is a new thing for the viewers out there. So,
That's right. That's right. So here's what we're going to start with today, though. This is a bone I've been needing to pick for a little while now. And this is actually a headline article in Barron's today. And this is you already know where I'm probably going to go with this in general, as even though you don't know specifically what I'm about to talk about. But the headline is this. This is in Barron's. Annuities are soaring in popularity. They're not all as safe as they seem. So at least they give you something in there to say, hey, buyer beware. And as the audience knows, like anybody that's watched this program for a little while, usually we start with viewer questions. Love the questions. You can drop them right in the YouTube channel here. You can call, text, email us, anytime. Just go to shepherdwm.com. And there's all the ways to get a hold of me and send those questions. But this, usually we start out with a topic either because of a question that viewers or clients of mine actually have, or something that I see, based on a client interaction. And this is something that I've seen for quite a while now. So annuities in general have been around but they're in general, in my experience, a terrible place to go about making an investment. And this article kind of talks a little bit about some of those risks, but I did want to give the audience some context here. So total U.S. annuity sales reached a record of $385.4 billion in 2023. That's a 23% increase from the prior year, being 2022. So starting with that, right?
what?
$5.4 billion, 23% increase in annuity sales in the year 2023. Now, why do you think that is? It's because 2022 was the worst year that you've seen in the stock market since 2008. That's exactly the reason why that those sales spiked. And for the audience, listening to this, If you're an annuity salesperson, first of all, you don't most likely have any securities license because a lot of these things aren't even securities themselves. You might have a securities license, but in general, you probably don't. You just had to pass an annuity test. Generally, there's a health and life portion of this test. It's about 50 questions, for the health, 50 questions for the life, and it's about the simplest damn test you can possibly take. I have a daughter that's about to be 16 years old, and if you gave me 30 minutes with her, she doesn't have any idea what an annuity is. I could probably have her pass that test if you gave me 30 minutes to just help her understand what a fixed and variable annuity is. She'll probably pass.
Yeah,
Okay.
I don't want to exaggerate here for the people listening, but the people that sell me my Taco Bell going through the drive-through, the conversation we have in that brief window of time when I get my amazing $5 box, they could also pass that test.
Yes.
And I'm not disparaging anyone who works at Taco Bell, but the leap from Taco Bell to selling an annuities person is minimal. It's
Yeah.
nothing.
Yeah. There's a big difference between the annuity salesperson and somebody like myself, right? There's a huge
Huge.
gap of education, experience, like job, completely different, and compensation different. So where I'm going with this, for those who don't understand how these folks get compensated, they're straight commission in general. They might get a small salary, but in general, straight commission.
Yep.
And
Work on tip.
usually, yeah, usually this is a different kind of tip though. Um,
Huge. Yeah,
these
that was a bad
these
analogy.
annuity sales, yeah, these guys are getting that 8 to 10% rip. So what that means is, you know, if you're selling a policy, an annuity that somebody wants to invest $1 million in, and they get a 10% commission on that annuity product, let's say it's going to be somewhere in that 8 to 10% range. $1 million, that's 100 grand right then and there for the annuity. Now you might be saying, "Damn, I need to get in the annuity sales business. These guys are selling, record numbers here, and I'm getting 10% rips." And the barrier to entry into this industry is extremely low, right? You might be thinking, I'm in the wrong business. Well, the reality is the reason why the annuity sales spiked in 2023 by 23% is because they were placating to the individual investor's fear. They're placating to the fear of knowledge. Because if you actually look at the prospectus, so mutual funds, ETFs, they have a prospectus. If you're doing research on a publicly traded company, they have all these quarterly earnings that they have to produce all the documentation to the SEC. So there's a lot of information to look through. Most people don't look at any of this stuff. We're talking about basic investment vehicles, mutual funds, ETFs, looking at 10Ks of publicly traded companies, their SEC filings. Nobody looks at that. So they're sure as hell not going to look at, Old Testament style thick prospectus for an annuity product, right? You're just not going to read it. First of all, you're dealing with lawyers who wrote this that work for an insurance company. So by default, they're going to make this so dry and boring that even the most savvy accountant or financial professional would just start drooling all over their table as they start to read this thing. Okay, but that's what's going on here. Worst year, 2022, S&P 500 is down 20%. Oh, by the way, bonds, which were quote safe investments in most viewers' eyes, they were down 18%, almost as bad as equities. This is the worst year for a 60-40 asset allocation in the history of a 60-40 asset allocation. This is how the annuity sales spike happens. It happens every single damn time we have a really rough year for whatever the reason, geopolitical, some sort of macroeconomic event like the pandemic. That's where you're seeing huge spikes in annuity sales. And the reason why I'm bringing this up today, other than the fact that this is a headline Barron's article, outside of all the inflation stuff we're about to talk about here today, new customer comes on board and we have the normal conversation. What are you looking to accomplish here? Why would you hire an advisor? Have you worked with anybody like us before? And through that conversation, come to find a huge amount of investment, way bigger than six figures. All right. Invested 100% in a couple of different types of annuities. And they did this under the exact same time that all $385.4 billion worth of annuity sales happened, they were caught up in this exact same thing. Okay, they were professionals in a field that required a lot of their time, energy, and attention, and they simply did not have the time, energy, or resources to devote towards doing research to make informed investment decisions that would help them achieve a goal, in this case, retirement. Now they are in retirement, but they actually have enough guaranteed income, Social Security and pensions, and very low, actually zero debt at all. So all of their income that's coming in through guaranteed sources has nothing to do with the stock or bond market, is way more than covering their monthly lifestyle costs. So they met with this quote professional advisor, annuity salesperson, actually. Again, these professionals didn't have any understanding of how annuity people are compensated, how they got in the industry, pros and cons of annuities versus other investment vehicles. They didn't know none of this stuff. They just put 100% trust in this person, probably because they're a really nice individual, probably dressed sharp, probably looks smart, looks intelligent, clean cut, all that sort of stuff. All that shit means nothing, right? This is the reason why you see me walking around Cincinnati, Northern Kentucky, in a golf polo or a quarter zip all the time. If people are like, oh, man, why don't you wear a suit or whatever? That's fine and dandy. If you want to wear a suit, three-piece it out, I don't care. I used to do all that stuff when I worked at TD Ameritrade and other places. It means zero. It doesn't make you smarter as an advisor. It doesn't help you communicate better. So I'm going to be comfortable, because I'm very comfortable in my own skin as a financial advisor. So I'm going to portray that outwardly as well. So just a little side note there. So I'm sure this person looked the part, sounded the part, and was placating to their emotions. And the issue is, when you're selling an annuity, usually the reason why you're doing it is for one of two reasons. One, you're so afraid of what might happen in the market, you just want complete security protection on your assets. And you're trading that risk to an insurance company, annuity company. Fine. There are different types of annuities for that, and that's a completely different ballgame as well. That maybe we'll spend a whole episode talking about this one day. The other reason why you would do it, and this is the most common reason, is you're looking for a guaranteed stream of income. You're taking the risk of potentially running out of your own savings. You're taking it off of your shoulders and you're putting it on an insurance company. That's fine. You would think that that's what this couple wants, because part of their goal is to spend all their money because they don't have any children, and they don't want to leave it to the government. They might have some charitable things they want to give to you, but in general, they want to kind of spin this down. But they lock their money up in this annuity that has a 10-year surrender, and it's 10% a year for the first 6 years or 7 years of this 10-year surrender penalty window. But the real kicker is they're capped on their performance at like 4.5%. So they bought this product in 2023, just like everybody else did, after a year where you've seen some of the worst performance for stocks and bonds since 2008. And if you were a 60-40 allocation, this is the worst performance of that allocation's history. They bought this knowing that they want to spend the money down, but they can only touch about 5% of their total investable dollars in the annuity per year. They don't have full access to it, even though they do want to spend it down. And we're capped at 4.5%, when in 2023, the S&P 500 is up like 24%. Our customers here at Shepherd Wealth Management, thanks to take and lens on historical data, on average, we're up 35%. Now, we're sharing all this information with them. And what the real eye opener was is, one, they didn't know that they were capped at 4.5%. And when they go to call the advisor, or the annuity salesperson in this case, I wouldn't call them an advisor, they called this person to kind of confront them, not in like, hey, I'm angry at you kind of way, but a way of saying, like, hey, as if you were the advisor. The conversation was such that it was like, hey, as I know that we invest in this product, year and a half, 2 years ago. We told you that we want to spend our money down, but the first question is, do we have access to our money? And the advisor's answer is, well, we have to follow the rules. They were like, well, what rules? We just want access to the money. We're like, well, if you recall, which they don't, because they didn't read that Old Testament style prospectus. And the advisor, of course, once they sell this product, is not going to talk to the customer again, right? Why would you? Because they're locked into the damn thing for 10 years. And if you want to get out, you're going to sacrifice, 10% of your gross investment, not even the gains. So the gains are gone. So if they surrender this thing, the gains that they had, that 4.5% cap, those are freaking gone,
Yeah, and
right?
the
Plus
advisor's
there's
not
a
looking for more people to put on the hook, they're not trying to actually help anyone. They're a
exactly. So this
salesperson.
is this is a sales job. They close the book on it once it's sold because they got paid. Insurance companies getting paid. And they also didn't understand the actual underlying fees within the product itself because they weren't stroking a check. It was actually just coming internally, right, from their own stuff. Again, all this is in the prospectus. The insurance company is not going to get sued in this instance. The advisor or annuity salesperson is not going to get in any sort of legal trouble for any of this stuff at all because, again, it was written down in a prospectus, but probably wasn't fully disclosed and certainly was not read by the individual investors. So the takeaway for all of you listening that have either considered annuities or might have an annuity, if you have one, call me. I can help you understand what you're not seeing and what your options ultimately are. But for this individual customer, it did actually make sense for them because, again, they don't have children, they have plenty of income, they just want access to the funds and be able to spend it. It made sense for them to surrender a portion of their investments in the annuity because of their circumstances allow them to do that. And they're tasking us with making up the 10% haircut that they had to take off the portfolio. And we're going to take on that challenge. And actually, I was so appalled by the annuity salesperson's tactics here, and I'm sure I would feel the same way about all these other people that are in this Barron's article, that we actually gave them a pretty significant break for a period of time here from a fee standpoint on our end, just so that we're able to make up the ground, that they unfortunately missed out on
Oh, that's so rad.
because of the tactics here. So I'm not saying I'm going to do that for everybody with an with an annuity sob story. So please, audience, don't expect that to happen per se when you give us a call. But this was one of the worst ones that I've ever seen, and I've seen a lot of them. So that's a little bit about annuities. Huge caution sign for anybody out there considering it. And if you already have one, let me know about it. We got a couple other customers that I could have this annuity conversation for weeks on end about all the reasons why it's not something that you want to participate in as an individual investor in general. There might be some one-offs, but in general, terrible idea for most individual investors.
Yeah, I think it was maybe season 2 of the podcast. You did a huge episode on annuities and why they were a bad idea, and it was right when everything was just at the apex of being horrible with the economy. I mean, do you remember that? Maybe it was season
I,
3, but you had a bunch of customers from SWM coming and asking you why weren't you participating in annuities with their funds, and we had to do a show about it. So
yeah, 100%. I mean, there's so many things. I might actually, need to do a full show on this because the truth is,
yeah.
we're coming up on election season,
Oh God.
and instead of having to talk about that every day, like we've kind of had to talk about the Fed and Chair Powell and all that stuff for 2 years now, really. We're not done talking about that yet, but
No,
we are
we
going to
haven't
be
really
pivoting.
started.
We're going to be pivoting towards this election conversation shortly. But maybe just to mix things up here, we might do a full blown, I'll actually break down why annuities compared to other alternatives is most likely not in your best interest. I'll even get some statistics and some history for us on that one. But
Yeah, I mean, it's been such a wild ride, I think, in the last 15 months. We haven't really had to do a specific show like that, but that's probably a really good idea.
yeah. I mean, you guys can do the math. $385.4 billion on fear sales. 10% rip to the annuity salespeople ish. That's a pretty good number. And I honestly think there's only so many of these kind of products you can sell before you have to repent. But I don't know. That's why I don't do it. I mean, I could do it, but there's just nothing about the product that makes any sense to me. in any way, shape, or form. So we do not do that here for anybody at Shepherd Wealth Management, even if you were a customer that made all the sense in the world for. It's just not a product I can get behind. So
Yeah, well, this is probably a good reminder for folks. We are an actual investing firm. You are, I'm just a podcast guy. Um, this is an actual uh, practicing firm, and the mission statement is very real. We have your best interest in mind. So if it's not a good product, it's not going to get put on the table for you. So,
100%. So if you got questions about, annuities in general, fixed variable, everything in between, please email 513-630-2664, and we're happy to address that. And we'll likely make that a future podcast show coming up here. All right, now let's get to the actual data this week. So a ton of information. I'm going to cover it with you all, but mostly this is going to be me kind of reacting to not just the data, but more importantly, the press comments that Fed Chairman Jerome Powell had to say. Well, let's start with CPI here, since this is the headline inflation number. So May core CPI was released yesterday, 8:30 a.m. It was a huge downside reading, which is a good thing. The reading came in at 0.16% month over month. The estimates were 0.28% month over month. So that was great. So how did that all happen? So we've talked about two components that have been propping up headlines, which is CPI, the number we're talking about here. We've talked about two things that have propped up the headline CPI number. One is auto insurance, and their premiums have been skyrocketing 23% year over year. We expected that to come down. And the reason why we expect it to come down is because used and new car prices skyrocketed during the pandemic due to shortages, the chips, etc. And when car prices go up, the parts go up, the cost to maintenance the cars go up. Therefore, the technicians are more expensive to pay, and therefore it's more expensive to actually move the product, whether it's a actual fully made vehicle or the parts and components that make up that vehicle. All that stuff costs more. So when you get in an auto accident, etc., it's going to cost more to fix all these things, of course. So auto insurance companies have to pass along this increase in cost to increase in premiums. Well, if you're an auto insurance company, you are state regulated in each state that you're doing business in. So if you want to increase your auto insurance premiums, you have to get that approved by each and every state you're doing business in. Of course, this doesn't all happen in 1 month. It's getting spread out over multiple months. This is one of the reasons why the headline CPI number has been propped up. Specifically for the first quarter of this year, January through March, we saw higher than expected inflation readings. One of the components for that was auto insurance. Again, it was up 23% year over year. In this reading that we just got yesterday morning, auto insurance was flat. It came in at 0.0. So last month, auto insurance added 0.06% to the core reading in last month's CPI. So yes, this is a huge difference from the prior CPI reading. And this is a big reason why that core CPI print that we got yesterday came in significantly below the market's expectations. Now, that's only one of the two. The other one was housing. Now, we all know, and the Fed, admits it almost every time that they have to get in front and actually answer questions from reporters. They know and understand that housing and what they call owner's equivalent rent has the longest lag effect. But housing plus the auto insurance is about 45%, roughly, of the entire CPI calculation. So those two components have been propping up that headline number all year long. But now you're starting to see at least one of the two falling substantially. And of course, we expect housing to fall in line as well at some point in time this year. And that's where you're going to continue to see these major downside surprises. Now, I'm going to get to the Fed's comments here in just a little bit, but I want to talk about PPI and the expectation for Fed rate cuts. The market was expecting the expectations for Fed cuts is now higher post the CPI announcement. It was 1.5, it went to 2. So that's great. And that's a big reason why we saw a stock market rally after the CPI news was released yesterday morning at 8:30. It was especially positive for small caps because we've talked about this in prior podcasts, is that small caps from a historical perspective, here's your one history part here, typically do the very best and they do better than even large caps when we go through an interest rate cutting cycle. Now, we're not there yet, but the fact that increase in the expectations that the market has for Fed cuts increased a little bit yesterday post CPI news is a big reason why small caps had a fantastic day, and the home builder sector, ticker symbol ITB, had its best day all year. I forgot where it closed that as, but it was up over 5% on the heels, of this softer than expected CPI print, which is exactly what we've been calling for here all year long. Right? We've called this out, I don't know how many podcasts ago or how many months ago, that these two components, housing, auto insurance, are really propping up CPI. And we have some data points here that kind of help the audience, further understand this. So the components of CPI are showing a much healthier picture than the actual CPI number. So if we look at the percentage of CPI components with inflation below their pre-pandemic average, that number is 51%. So this is above the 50% average since 1980. So in other words, roughly half of the CPI components have inflation rates below their pre-pandemic averages. And we also have ISM surveys, and both manufacturing and services show prices paid readings back to pre-pandemic averages. So again, the average component of CPI is substantially below the Fed's target, and it's also below its historical average. So that gap between headline CPI, which stands at about 3.6%, and the median component of all CPI, all the components that make up CPI. So if core CPI is 3.6, the median CPI is 1.6. That gap of 2% is going to get filled when auto insurance continues to fall and shelter eventually shows up in the CPI data in a good way. All the leading indicators for things like rent and home prices are coming down. Right? This is Everybody understands that when you have interest rates at 7% on 30-year mortgage, you have less home sales. So it's just eventually going to show up in headline data. And it's very obvious when you actually look at everything else that makes up CPI that inflation is in fact falling and is on a sustainable path towards that 2%, which is what makes the whole conversation that Jerome Powell had answering analyst questions very odd. So I want to get to that in just a little bit here. But again, I don't see anybody talking about this in headline news. The only person that's bringing this up, I'll say two people. Tom Lee, Fundstrat fans, we do love their data. We tend to follow their work quite closely because they do have a historical lens on the economy. And obviously, we're really big fans of that. And the other person that really called this out yesterday was Steve Leisman, which is a CNBC reporter, he's an economist. He also kind of mentioned very similar things. You can just check him out on YouTube, kind of get his thoughts post the CPI announcement yesterday. But we also this morning, so CPI yesterday, I'll get to the Fed's comments and my reaction to them. But this morning, 8:30, we get the wholesale inflation number, otherwise known as PPI. And and just for all those newer folks out there wondering what this is, the Producer Price Index, PPI, is a gauge of prices that producers get for their goods and services in the open market. This declined by 0.2% for the month against expectations for a 0.1% increase. So substantial decline in the Producer Price Index. Additionally, at the same time this morning, 8:30, we have initial claims for unemployment insurance jumped to 242,000 for the week ended June 8th. This is the highest level since August of 2023. So you're seeing a softening in the labor market, although we're not seeing substantial softening. Powell admitted this yesterday as well. Since we have the unemployment rate is at 4%, which is historically low, based on any period of time you really want to look at.
Yeah, any.
But it has been increasing, right? So pre-pandemic, we were around 3.4% unemployment rate, something in that area. And now we're at 4%. 4% is not bad. from a historical perspective, 4% is actually considered, quote, full employment. And one of the Federal Reserve's mandates is maximum employment, right? That box is still checked. The other one is price stability. There's a huge question mark there based on the comments that Powell had to say yesterday after the news, was made public, which I'm about to give my reaction to here in just a second. So one of their mandates, box is already checked. The other one we have a question mark for. But do we really have a question mark here? Right, based on the average component of CPI being below their pre-pandemic average and below their historical averages, and you're getting PPI, the wholesale price, substantially below economists' expectations. I don't know, Ez. I think the Fed's playing a little bit of chicken here with the economy and seeing how long they can hold rates without breaking something. But to me, as you're starting to see some of these unemployment insurance numbers start to creep up a little bit, unemployment's creeping up just a little bit. It's not enough to get everybody all worried. The Fed even said, hey, if we saw a substantial spike in the unemployment rate or like the numbers we're talking about here, initial claims spikes, substantially above what they might have been expecting, they're ready to react to that, is what he said, meaning they're going to cut rates if the labor market starts to soften. Again, that's one of the two mandates. But you're just not seeing an acceleration of that, nor do we expect that, nor does the Fed expect that. So they're really hanging on to this higher for longer game of chicken, hoping that they're going to continue to see readings like we just got yesterday and this morning over the next month or two. So they have, greater confidence, is their actual words, that inflation is going to be a sustainable path towards that 2%. Well, the real fly in the ointment here is that is all subjective, right? How much confidence was the question needed? Because we saw 3 months, January through March, of higher inflation readings. Well, we called that out here on this very show. If we were talking about the two components propping up CPI, we're also talking about the seasonality of inflation data as you turn into a new calendar year is generally going to be a little higher. We've talked about the reasons for all this. Nobody has been talking about this in the news, and sure as hell, the Fed has not been talking about any of these forward-looking economic indicators, or if you want to look at what history has shown, in a new calendar year as it relates to inflation, they don't talk about any of this stuff. They just became more hawkish with their rhetoric, and therefore the market really doesn't know what to do with interest rates. Interest rates have been as close to 5% again on the 10-year just a month ago, and now we're trading below 4.5%. So you're seeing just volatile movements, with interest rates. You're seeing volatile movements potentially on a day-to-day with the stock market because the Fed is completely unsure. They're so unsure, in fact, about where we're headed. Here's the other piece of data that I thought was very interesting here. I'm going to find it. Here we go. So this is from Mark Newton. He's the head of technical strategy at FarmStrat. And I'm going to quote him for a little bit here. So here's what Mark had to say. Powell's comments might have seemed more hawkish to some given this morning's weak CPI, having teed things up for a more dovish tone. So again, CPI came in below expectations. I would have thought Powell would have been teed up to just say really good things about potential rate cuts starting in September. He completely steered away from that. Getting back to Mark's comments here, quote, yet their key message seemed to be simply that disinflationary trend seems to be happening more slowly, and they have the same trajectory for cutting rates, but just on a delayed time frame. Dot plot seems to be suggesting that the Federal Open Market Committee simply has no idea, as 4 members suggested no cuts, 7 members said 1 cut, while 8 said there'll be 2 cuts this year. So the difference was just 1 vote between 1 cut and 2 cuts. Certainly a confusing, bifurcated message, and treasuries along with stocks have retreated a bit from earlier morning gains. This is why we're seeing this substantial fluctuation between interest rates and stocks. Powell went on to say, Powell did speak about the overstatement of payrolls and seemed to suggest that 2.6 to 2.7 was a fine place to be. So we're not very far away from that. So the question was asked, all right, we saw 3 straight months, January to February, higher than expected inflation data, even though history gives you all the reasons why. There's seasonality, noise in that data, etc. The Fed became very hawkish in their tone. Expectations for interest rate cuts went from 7 at the beginning of the year in January down to maybe 1 as we were coming into April, and now we're at about 2 rate cuts, even though yesterday the Fed themselves said they're only expecting 1 rate cut. And the question was asked, well, did that dot plot that Mark is talking about here, did that factor in, the news that we all got today of CPI being substantially below consensus expectations? Al said it did, but here's what he also had to say. He said, yeah, we were briefed on it when the CPI news came out that morning. So again, this came out at 8:30. The Fed's announcement is at 2:30, right? This is when Powell was speaking the same day. So all the committee members, all the people that voted, no cuts. 7 said 1 rate cut, and I think 8 said 2 rate cuts, right? They don't know what's going to happen. But Powell gave them the opportunity to update their dot plot or their interest rate expectations. That's really what that dot plot is. It's not a game plan that the Fed has. It's just the individual committee members, based on all the data, here's where they think rates are going to go, and here's how they would approach potential monetary policy if things, kind of continue this trend, right? That's what the dot plot is.
Yeah, it's more of a
and they don't know what's going to happen.
Poll. Yeah.
Definitely not real time, because CPI data in and of itself is 1 month lagged, right? It's data from a prior month. It's already stale data in that regard. But the dot plot is stale data. This is the reason why the market had a really good day yesterday. It could have been better had Powell not been so wishy-washy in how he was, communicating the Federal Reserve's expectation for inflation and therefore their path for interest rates. Extremely wishy-washy, which is why you're seeing all the ups and downs and volatility here. It's just, it's unfortunate. I can understand why individual investors kind of throw their hands up and say, forget all this stuff. This is rigged or whatever their emotional response might be in the moment. I kind of understand all that. And the point of it is none of those committee members, he said they're allowed to update that dot plot response post that CPI. But he said on that, generally nobody does that. So not only is the CPI data a month stale, but their dot plot that he is now answering questions on, like he's getting drilled with questions all afternoon on their dot plot, because they're basically saying, hey, we expect unemployment to remain at 4%. We expect GDP to be good, but not as robust as what it has been. And we actually expect inflation to be just a tick higher than what it might actually be in the readings that we got here today. But they're also saying that we're going to give you 1 rate cut. The question was, well, why even give a rate cut if your own dot plot is saying unemployment is going to be right here for the rest of the year, and you're actually expecting inflation to be a little higher than what it is here today? Like, why would you even have a rate cut? And it's like, well, all these committee members are going to be able to change their dot plots, yada, yada, yada. This is, a meeting by meeting data collection, decision, if you will. He was trying to cover for them because they're just too damn lazy or too stupid to go about saying, yeah, this is going to be questions that, reporters are going to ask based on the data that we just got here this morning. Maybe I might want to sit here and reconsider this. They didn't want to take the time to rethink their entire process. They said, well, 4 of them said, to hell with it. No rate cuts at all. And again, 7 said we should get 1, 8 said we should get 2. So the bottom line is they don't know. But here's what you do know based on that conversation that Powell had yesterday with reporters, is that no one has an interest rate increase baked into the cake here. And I've said it all year long. Even if you had no interest rate cuts this year at all, it should still be a really good year for stock market participants. It already has been. Already up double digits on the S&P year to date. Technology is certainly leading the way. So as long as we're not having a real conversation about increasing interest rates, which again, nobody is. Powell admitted that again yesterday. Nobody on the committee is baking in an interest rate increase this year at all. And certainly not after 2 straight months of good CPI data and now 2 straight months of excellent wholesale inflation data being PPI. I bet a lot of those committee members are probably kicking themselves a little bit here this morning, just due to the fact that they were, in my view, extremely lazy. Hey, they're going to have the job no matter what my opinion is. And they don't really return any of my phone calls here. So that was the
But
Fed
they
day in a
do listen.
nutshell.
They do listen to this show.
Yeah, I mean, and you're even seeing this, showing up today in Barron's. Why, headline articles such as this: why the Fed is unlikely to cut interest rates before December. This is why individual investors that have a full day job, right? Engineer, teacher, firefighter, whatever. You might get little blurbs of stuff like this on your phone, like headline article, Fed's not going to cut rates until December, maybe, dot, 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 question mark, right? It's going to freak you out a little bit. And unfortunately, people don't have the time, energy, or ability to actually peel the layers of this conversation back, look at the underlying data that caused him to say the types of stuff that he did say yesterday. And that's really what this program's all about. This is what Shepherd Wealth Management is all about for our customers, because I do understand that they're enjoying their retirement. I understand that they're enjoying whatever it is that their profession is at this time. They're enjoying the summer with their family and kids or grandkids right now. My job is to make sure that we're informing them as to what's going on, but more specifically, what's behind the numbers, what's behind the reaction. What's my reaction, since I'm the one responsible for making the investment decisions here for nearly $100 million of assets under management. Not quite there, but we're coming up on that. I'm very excited about that. I look forward to celebrating that huge milestone in the coming weeks and months here. I'm not sure what exact date that might happen, but I'll certainly let everybody know. So that was it, man. I know we covered a lot of ground there between annuities, the greater picture on CPI and PPI, the data and the underlying data, jobless claims, the Fed's reaction, of course, my own reaction. But I kind of wish, and maybe we should think about this as for future podcast shows or just the audience in general, like Fed Day, like yesterday, if we had like a mystery camera somewhere in my office where I didn't even know where it is, or where you guys can really see my reaction.
Yeah, nanny
Uh,
cam. Get your nanny cam set up.
we would have to be able to blurt out certain things as far as my response would go.
No, this is HBO style content.
That's true. I mean, it is YouTube. You can almost say anything you want to. Not everything,
Almost.
but you can certainly talk, more honestly about the actual feelings. So I think we covered a lot of ground here. We talked about annuities as well. So I'm kind of all tapped out here on the podcast today, as I think we're right around that time anyway.
Yeah, we are.
And certainly looking forward to doing this again. Probably won't see us until after July 4th. For all of you out there with fathers, hope you guys have a great Father's Day. If you are a dad, congratulations. Job well done. Spend it with the family. And please enjoy the beautiful weather that we're about to have here. It looks like here this summer in the Midwest area. And we'll catch you guys again almost every 2 weeks, but this time it'll be more like 3 weeks post July 4th. I hope you guys have a good 4th and look forward to all of your questions and comments. Other than that, take care, guys. Have a great rest of your Thursday.